Let's get back now to our market panel. Ed Clissold from Ned Davis Research, Katie Kaminsky from Alpha Simplex. Guys, welcome. Katie, right before noon in today's trade, it seemed like things changed. The 10-year yield is up significantly today, but backed off of its highs above the yield of 4.354. So what does it mean that the S&P and NASDAQ were still able to make notable gains with the 10-year above 434?
I think that's what's so exciting today. I mean, really, it was a huge day for the Treasury market, and we're seeing a positive return in the stock market, something we didn't see last week. What is interesting for us is we think rates are going to be higher for longer, and maybe the stock market's okay with it. I mean, maybe that's what's going on.
Okay, so Ed, is that good news for the rest of the week, or does it put more pressure both on NVIDIA, which was up significantly today, to turn in earnings and a guide Wednesday on overtime that makes people continue to feel good, and then does it put more weight on Jackson Hole?
Well, I think in terms of these really large tech stocks, if you say take the 8 largest tech stocks, they as a group account for 28% of the S&P and about 18% of earnings. And that 10% gap is about the largest on record. So can they continue to rally? Yeah, but they really need their earnings to come through to justify the rallies that they've already come. So I think the pressure has been ratcheted up on those companies to deliver.
But specifically, Ed, if you can talk about NVIDIA, we were just showing the chart. It was up about 8.5% today. AI has been fueling a lot of the excitement, not just behind NVIDIA, but also behind Microsoft, some others. I mean, do these bigger tech names need for the AI narrative to continue to have momentum? And is that tied to NVIDIA or no?
Well, our compliance doesn't allow us to talk about individual companies, but in terms of AI in general, that has been the big sentiment driver, and there does need to be something behind the sentiment, and the fundamentals need to start coming through to justify what has already happened. Now, a lot of times whenever there's a big move, people compare it to the dot-com bubble. This is a long way from that in terms of the kind of gains that we've seen so far, and that these companies, a lot of them, do have good businesses behind them in addition to AI. They have something to fall back on. So we don't want to get too draconian in our conversation about it. But if they're going to continue to outperform and be market leaders, they're going to need to start to put some better earnings growth behind what they've done.
I want to mention here, we've been awaiting Zoom earnings. They are out. That stock looks to me like it's popping about more than 7%. We're going through those numbers. We'll bring them to you as soon as we have clarity on them. Katie, where, if at all, does China fit into this puzzle for you? A little bit of a hike here on the rate. They need some growth. There are concerns about whether global markets get dragged down if China worsens. How does that factor into your outlook and how you're investing right now?
Well, I think the challenge has been you've seen such a divergence. I mean, the U.S. is looking very strong, while China has definitely been disappointing recently. We've seen that particularly in the oil markets this month. You're seeing some mixed results there, and it's also affecting some of the currency markets. So we're definitely seeing some big moves in terms of the Chinese yuan, and that's providing some interesting opportunities for trading around that divergence between what's going on here and what's going on there.
But what about China as a market itself and its impact? For example, back half of this year, the likes of Apple. I mean, Greater China is an important market for them. We've seen the luxury market in China hold up better than the economy in general. Should we expect to hear more about China weakness affecting some of the expectations in these companies' numbers, or is there enough insulation from renewed growth elsewhere, higher than expected growth in the U.S., for example, to sort of shield from that?
Well, I think this is where this month has been important. This month, we've seen that negative or disappointment in China turn from what was a relative positioning for the U.S. to, oh no, this could actually leak into somewhere else. And particularly oil prices, copper prices, and other raw commodities were showing some of those moves. So I think it's definitely a new narrative to start thinking about. Is there some contagion that might also leak over into U.S. companies as well?